Type of mortgage. There are several types of mortgages, each with its own set of terms and conditions. Here are some common types. Fixed rate mortgage (FRM). This is a mortgage with an interest rate that remains constant throughout the entire term of the loan. Monthly payments for principal and interest stay the same, which can provide stability and predictability for homeowners. Adjustable rate mortgage (ARM). An ARM has an interest rate that can change periodically, usually in relation to an index such as the U.S. Treasury bill rate or the London Interbank Offered Rate (LIBOR). These changes can result in the increase or decrease of the monthly payment. FHA loans, Federal Housing Administration, insured by the FHA. These loans are designed to help lower income and first-time homebuyers. They often have more lenient qualification requirements but may require mortgage insurance. VA loans, Department of Veterans Affairs, available to eligible veterans, active duty service members, and some surviving spouses. VA loans offer favorable terms and typically require no down payment. USDA loans, backed by the U.S. Department of Agriculture. These loans are designed for rural and suburban homebuyers who meet certain income requirements. They often feature low or no down payment options. Interest-only mortgage. Borrowers only pay the interest on the loan for a certain period, usually the first few years, after which they start paying both principal and interest. These mortgages can provide lower initial payments but may result in higher payments later. Balloon mortgage. This type of mortgage has fixed monthly payments for a specific period, after which the remaining balance of the loan is due in a large lump sum. Borrowers often refinance or sell the home before the balloon payment is due. Reverse mortgage. Typically used by senior homeowners, a reverse mortgage allows homeowners to convert part of the home's equity into cash. The loan is repaid when the homeowner sells the home, moves out of the home, or passes away. Jumbo mortgage. These are mortgages that exceed the limits set by government-sponsored enterprises like Fannie Mae and Freddie Mac. They are used for higher-priced properties. It's important to note that mortgage options can vary by country, and these are general descriptions that may not cover all variations in different markets. When considering a mortgage, it's advisable to consult with a financial advisor or mortgage professional to find the option that best suits your financial situation and goals. Title: Mastering Your Mortgage. The Ultimate Guide to Fixed Rate Mortgages (FRM). Welcome back, mortgage mavens. Today, we're diving deep into the world of home financing to unravel the mysteries of fixed rate mortgages, or FRMs. If you're considering buying a home or refinancing, you're in the right place. I'm your host, and together, we'll demystify the intricacies of FRMs to empower you on your home buying journey. What is a fixed rate mortgage? Let's start at the beginning. A fixed rate mortgage is a type of home loan where the interest rate remains constant throughout the life of the loan. Unlike adjustable rate mortgages, FRMs provide stability and predictability in your monthly payments. So, why is this important? Well, with a fixed rate mortgage, you won't be at the mercy of fluctuating interest rates. Your monthly payment remains the same, making budgeting a breeze. The mechanics of FRMs. Now, let's delve into the mechanics. Your fixed rate mortgage consists of two components: principal and interest. The principal is the amount you borrowed, and the interest is the cost of borrowing. As you make your monthly payments, a portion goes towards repaying the principal, and the rest covers the interest. In the early years, a larger chunk goes to interest, but over time, more goes towards the principal. Advantages of fixed rate mortgages. Why choose a fixed rate mortgage? Well, there are several advantages. Firstly, as mentioned, the stability in your monthly payments. No surprises or sleepless nights worrying about interest rate hikes. Stability, predictability, long-term savings. Additionally, FRMs are a great option for those planning to stay in their homes for an extended period. You can lock in a low rate and enjoy long-term savings. How to secure the best FRM. Now that you're sold on FRMs, let's talk about securing the best one for you. Start by shopping around for the lowest interest rates. Compare offers from different lenders to find the most favorable terms. Consider the loan term too. While the 30-year FRM is popular, a 15-year term could save you money in the long run with a slightly lower interest rate. Pitfalls to avoid. Before you sign on the dotted line, be aware of potential pitfalls. Some homeowners might feel constrained by the lack of flexibility in FRMs. If you anticipate moving or refinancing within a few years, an FRM might not be the best fit. Make sure to thoroughly understand the terms and any potential penalties for early repayment or refinancing. Tips for paying off your FRM faster. Want to become mortgage-free sooner? Here are some tips to pay off your FRM faster. Consider making extra payments towards the principal. Even a little extra each month can significantly reduce the overall interest you pay. Another strategy is to make biweekly payments. By splitting your monthly payment in half and paying every 2 weeks, you end up making one extra payment per year. In conclusion, as we wrap up our deep dive into fixed-rate mortgages, remember that knowledge is power. Whether you're a first-time homebuyer or considering a refinance, understanding the ins and outs of FRMs empowers you to make informed decisions. While the stability is a significant advantage, it does come with a cost. Some borrowers might find that the peace of mind that comes with fixed-rate mortgages is worth the potentially higher overall cost over the life of the loan. Is a fixed-rate mortgage right for you? So, is a fixed-rate mortgage right for you? It depends on your financial goals, risk tolerance, and how long you plan to stay in your home. If you value stability and plan on staying put for the long haul, a fixed-rate mortgage might be the perfect fit. That's a wrap on today's video.
Complete Mortgages Guide. Purchasing a home is a significant milestone for many, often representing a culmination of hard work and financial stability. For most individuals, this dream is made possible through a financial instrument known as a mortgage. In this comprehensive guide, we delve into the intricacies of mortgages, shedding light on their types, processes, and key considerations. What is a mortgage? A mortgage is a loan provided by a financial institution, typically a bank or a lending company, to help individuals or businesses purchase real estate. The property itself serves as collateral for the loan. This means that if the borrower fails to make payments, the lender has the right to take possession of the property through the process of foreclosure. Types of mortgages. Mortgages come in various forms, each catering to different financial situations and preferences. Some common types include fixed-rate mortgages. These maintain the same interest rate for the entire loan term, providing stability and predictability in monthly payments. Adjustable-rate mortgages, ARMs. These offer an initial fixed-rate period, followed by an adjustable interest rate that fluctuates based on market conditions. Government-backed mortgages. These are loans supported by government agencies such as the Federal Housing Administration, FHA, or the Department of Veterans Affairs, VA, often providing more accessible options for individuals with lower credit scores or limited down payments. The mortgage process. Acquiring a mortgage involves a series of steps that demand careful consideration and planning. The general mortgage process includes pre-approval, determining how much you can afford and getting pre-approved for a mortgage. Property search, finding a suitable property within your budget and requirements. Application, completing the mortgage application, providing necessary documentation, and undergoing a thorough financial assessment. Underwriting, the lender evaluates your financial background, credit history, and the property's value to determine the risk of offering you a loan. Closing, finalizing the loan agreement, signing the necessary documents, and disbursing funds for the purchase. Key considerations. Before committing to a mortgage, it's crucial to consider the following factors. Interest rates. Understanding the impact of fixed and adjustable rates on your monthly payments and long-term financial planning. Down payment. Assessing your financial capability to make a substantial down payment and considering the implications for the loan terms. Loan term. Choosing a suitable loan term that aligns with your financial goals and capabilities, whether it's a 15-year or 30-year mortgage. Closing costs. Factoring in the various fees associated with closing, including appraisal fees, title insurance, and attorney fees. The mortgage procedure typically involves the following steps and more detailed breakdown of the mortgage procedure. Pre-approval. You contact a mortgage lender or broker to get pre-approved for a mortgage. You provide financial information, including income, expenses, credit history, and employment details. The lender assesses your financial situation and issues a pre-approval letter indicating the maximum loan amount you're eligible for. House hunting. With your pre-approval in hand, you can start searching for a home within your budget. You can work with a real estate agent to help you find suitable properties. Offer and acceptance. When you find a home you want to buy, you make an offer to the seller, usually through your real estate agent. If the seller accepts your offer, you move on to the next steps. Formal mortgage application. You complete a formal mortgage application with the lender of your choice. You provide detailed financial documentation, including bank statements, tax returns, pay stubs, and more. Mortgage processing. The lender's underwriting team reviews your application and verifies the information you provided. An appraisal is ordered to determine the fair market value of the property. Underwriting. The lender's underwriter assesses your creditworthiness and the property's value. They may request additional documents or information during this process. Loan approval. If your application is approved, the lender provides a commitment letter that outlines the terms and conditions of the loan. You may need to satisfy specific conditions before the loan is fully approved. Closing. You and the seller agree on a closing date. You receive a closing disclosure document that details the final loan terms and closing costs. You attend the closing meeting, where you sign the necessary documents, including the mortgage note and deed of trust. You provide the down payment and closing costs, often in the form of a certified check or wire transfer. Homeownership. After closing, you officially become the owner of the property. The title of the property is transferred to your name. Repayment. You begin making regular monthly mortgage payments according to the terms of the loan, which typically includes principal and interest. You may also pay property taxes and homeowners insurance through an escrow account.
If you found this information helpful, give it a thumbs up, and don't forget to share it with anyone you know who's navigating the world of mortgages. If you have any questions or want to see more content like this, leave a comment down below. Thanks for joining me, and I'll catch you in the next video. Until then, take care and happy home buying. Stay tuned for more insights into the world of personal finance. If you found this video helpful, give it a thumbs up, subscribe for more content, and hit that notification bell to stay in the know. Until next time, happy home buying.